Hey everybody, Economic Ninja here. I hope you are doing great. Got two awesome stories, and why are they awesome? Well, it's not because I'm reading them, because I can barely read. But we're going to talk about the economy. We're going to talk about indicators that prove that we are crashing. And two of these stories I picked up today are really important because it talks about one being tax revenue. If the economy is doing so great, why are tax revenues off, right? That's a really neat indicator. Another one is the mentions of artificial intelligence in corporate filings. You know, we've seen all of these companies and wanting to use AI and everything's gonna be great in AI. And I'm like, hey, AI is going to take a ton of jobs out of our country over the next 2 years. And it's going to be proven. And there is a story basing the amount of mentions of artificial intelligence in corporate meetings, or sorry, quarterly filings, and how their stocks are not doing well. All right. So I think this is really neat information. So without further ado, I got my notes. So here we go. First story is out of Zero Hedge. It's entitled, "If the economy is so great, why are tax revenues so weak?" Real quick, before I get into this, if you don't mind me, do me a favor. I pinned a message, a video link to my other channel, Real Estate Ninja. That channel is blowing up, but there is a bombshell video that I have, and I want to share it with everyone because you are going to get to see the news 4 months before it hits the mainstream. And it's about mortgage-backed securities and how they are imploding. It's incredible. Please go check it out. And if you wouldn't mind hitting the subscribe button over there, because I don't know if you know this, this channel, it's in the penalty box. So it says here, excuse me, federal deficits continue to spiral upward, but deficits aren't just a function of federal spending. Deficits aren't necessary if tax revenues increase to match spending. But that's certainly not where we find ourselves in 2023. Rather, federal spending is rising even as federal revenues have fallen year over year for 10 of the last 12 months. So this is very happening. It's happening in real time. This is recent. Moreover, on a quarterly basis, federal receipts have been falling quarter to quarter since the third quarter of 2022. It's been long known that there's a pretty strong correlation between falling tax revenues and worsening economic conditions. Yet, even as tax revenues are falling, we're being repeatedly told that the economy is in great shape and there's no recession in sight. It's a great point. I want you to understand that as our government is spending money like a drunken sailor, that's a perfect quote, you have to realize, wait a minute, hold on, let me see something real quick. Checking to see if there's a water moccasin back there. All right. Point being is that there is a very big confusion going on. You see, as the government is pulling out tons of money in the form of debt, nobody's even really wanting to show up for its bond sales at this point, and it's spending money in the economy, it sort of spurs growth. People think like, oh, this is good. There's, you know, factories being built, and there's defense spending going on. You have to realize that is very short-lived, and it is in the wrong direction of where we want. We want the tax receipts to be higher. We want, no, let's put it this way. I hate taxes. Let's go. The Economic Ninja can't stand taxes. I think it is an absolutely horrible use of taking people's money, their hard-earned wealth, and then spending it in ways that they don't want to. I can't stand taxes. That's why I choose to fight the system by starting businesses and having legal tax loopholes in order to pay less tax, if not any tax, all right? The best way I found that is real estate, but I just want to go on record saying that, okay? But with that all said, when people are paying more taxes, it means they're making more money, okay? So this is proof that things are looking really bad. So let's get into some of the proof. There have been some periods where revenues went slightly negative without an accompanying recession. And we're talking about tax receipts, right? But not in many decades do we see a situation where year over year revenue has fallen to the extent that it has fallen in the recent months without a recession following soon after. For most of the corporate media's declarations of excellent economic conditions, look no further than the trailing indicator of employment or consumer spending. Consumer spending, of course, continues to be fueled by rising debt levels. Totally lost my spot. That's what happens when you look at the camera. Come on, Ninja. There we go. Consumer spending, of course, continues to be fueled by rising debt levels while investment falls. Get it together. Tax revenues present a problem for the everything is swell narrative. However, this can partly be explained if we consider what federal revenues nowadays are heavily reliant on income taxes and payroll taxes. So if wages and job growth were truly surging, as the Bureau of Labor Statistics insists via its payroll survey, we'd be seeing more growth in taxes on wages and income. The fact that federal revenues are falling suggests household incomes aren't exactly soaring. Is your income soaring? I'm just curious. Let me know down below. I hope it is, because you're part of Ninja Nation and you're setting things aside, you're getting ready for all this crash, but overall, the nation is not doing well. All of these raises that the president is touting can't even keep up with inflation, all right? It says here, the fact that tax revenues are weak and falling should not shock us if we're actually paying attention. However, real wages, and I know you guys, you are all paying attention. However, real wages are lower now than they were in January of 2020, before the beginning of the COVID recession. Looking at the CPI adjusted average hourly wages increased a whopping 2 cents from September 2022 to September of 2023. Wages are down by 0.06%, since January of 2020, before the lockdowns. In other words, real wages have gone nowhere in years. And this spells disaster in so many different markets. And you know what? I'm going to go live on the Real Estate Ninja right after this, talking about the 24 cities where housing prices are falling. And there's so many more. It's crazy. But I'm bringing you this news at the beginning of that cycle crash. This is where we want to charge the mound and get excited. All right, so let's talk about now the AI. Artificial intelligence has been touted by so many companies. Please buy our stock because we're using AI now. We're going to save lots of money, i.e. meaning we're going to fire a bunch of people and get ahead monetarily. This is bad. It's bad for the economy. AI eventually will really hurt a lot of people and a lot of incomes. And I think that people need to be aware of how serious this is. So this story I thought was really interesting. And it's also in Zero Hedge. It says, it's entitled Popping the AI Bubble. Companies that drone on about AI in earnings calls see their shares underperform. And the reason why they were droning on about it is because they were in fact trying to get people to buy their shares. It says right here, for much of the past year, we have said that countless companies would try to deflect attention from their sagging earnings by alleviating about artificial intelligence, ChatGPT, and so on, and other topical buzzwords, for the simple reason that merely mentioning that said trigger phrases could spark rallies under their stock, something which clearly wasn't lost on CEOs and CFOs. However, it now appears that the artificial intelligence euphoria has finally peaked. And according to the analytics done by Deutsche Bank, companies that discuss artificial intelligence the most in their corporate earnings calls this year have tended to underperform in the wider market. This is exciting because, you know, we saw this with Bitcoin and crypto when everyone was talking about blockchain technology, specifically the term blockchain in earnings. We were seeing a boom in blockchain stocks. As a matter of fact, we saw it so bad that there were companies that changed their name to have the word blockchain in their company. It was so crazy. It's a great point to make that investors can be widely, severely manipulated, because most investors are not investors, they're speculators, and they go diving in with these keywords and these emotional things. This is not, win one for the Gipper. This isn't a sports story. These are investments, and they should be made prudently. I'm not an investment advisor. I'm a dude with a bro hawk and a dream. Oh, stand by. I need some coffee. But the point being, how many people got their coffee with them? Beautiful morning today. I love it when the trees are changing color. Absolutely beautiful. I'm sorry, I digress. Get to the story, Ninja. Here we go. Artificial intelligence. Starting at the top, it's hardly a secret that many investors assume the buzz around generative AI since the launch of ChatGPT a year ago has driven the 2023 tech rally. Think about it. ChatGPT was released, November or December, we haven't even seen one full year of ChatGPT, and look at how much it's changed so many people's careers. Let me know down below if it's changed yours. It's definitely changed mine. We just now have computers fight our fires. All right, so after all, NVIDIA has surged 141% since ChatGPT was released, helping the NASDAQ 100 to a 20% gain. That alone should scare the piss out of you. We have got our indexes, our stock market indexes. You know, the ones where you look at your 401ks, you go, look at how much money I've got, because mostly it's ETFs and just crap, vaporware. Sorry, I digress. That's a whole different topic. But you've got companies that there's like 6 or 7 companies propping up each of these indexes because they're so massive. And when they turn, just ask Warren Buffett what it's like when Apple goes down a little bit, because he has so much money in there. I gotta be honest with you, this next year, 2024, is gonna be the year that all the big mighty ones fall. And then people like yourself and me, we run up the ranks because we were being meek with our money. It says, and yet, like DBs, like Templeman has found, several factors suggest that AI optimism has not been the key driver of tech markets across asset classes. In fact, DB's or Deutsche Bank's analysis shows that the companies that have discussed AI the most in their corporate transcripts this year have tended to underperform the wider market. Furthermore, we look at abnormal returns for semiconductor stocks. Deutsche Bank found that after an initial surge, the difference between their returns and those software stocks, another directly impacted industry, has fallen to be relatively non-meaningful. Yet, while management teams may believe that merely throwing around buzzwords is enough to propel their stocks to record highs, we can now conclude that the stock returns have been negatively correlated with the intensity of AI stocks. So now, where they went and thought it was going to be great, now it's actually hurting them. For example, of 77 Russell 3000 stocks, the correlation between the total return since Q1 and the intensity of AI talk in the Q4 of 22 and Q1 of 23 transcripts was down 29%. In part, this is because AI was more in focus for smaller and less profitable firms. In other words, corporate AI enthusiasm is sticky, unlike investor attitudes, which seem to be more discerning. And I hope that you're discerning, because 2024 is gonna be awesome. When I mean awesome, it's gonna be scary, but not for you, not for me, for the rest of the world. While there was visible outperformance wave in the first months of the year when tech benefited from a risk-on mood, as well as the aftermath of large drawdowns in 2022, later on, big tech rallied on the back of perceived haven status amid this SVB or Silicon Valley Bank sell-off, followed by another advance around the upbeat forecast from NVIDIA last May. You know, isn't it interesting? It's totally interesting to me that tech would have been considered a safe haven. Now, this is where, you know, the markets have gone wonky, and crashes take quite some time to make in full. You know, I'll give an example. 2005 was when everything blew up in mortgage-backed securities, right? 2006, Ben Bernanke is saying there's no way houses can fall down. 2005 also was when Germany was in a big recession and getting bailed out by the European Union. It wasn't until 2008 that you saw Bear Stearns and Lehman Brothers crash. It wasn't until 2010, 2011 that you saw the bottom of the housing market. That's how long it takes for a cycle. That's why I've been trying to prepare people for this, right? But you got tech laying off so many people last December, last January. It was all over the news. And then all of a sudden, Silicon Valley Bank, the banking crisis happens, and now all of a sudden it's like, oh, run to tech. You're like, well, wait a minute. Don't you remember what happened a few months ago? They're laying off everyone because they're screwed. Oh yeah, but they're a safe haven. Because it's funny how people have very little ability to just go to cash. So many investors have that FOMO where they're like, well, I have all my money in tech. Now I'm pushing it all over to banking, and now I'm pushing it over here. It's gotta be somewhere. No, sometimes it's better to be in cash. I made that call last spring where I said, hey, I'm selling off 1/3 of my entire portfolio in the commodities sector to buy back at cheaper prices. I got told I was an idiot. Well, guess what? All of those stocks are back to what I paid for them. And I sold them at 100% profit back in the spring. Now, have I rebought them? I have not. Why haven't I? Because I believe there's further weakness, to be honest. Now, I could be wrong. And at 1/3 of your entire portfolio, it's not like the biggest thing in the world, quite frankly. And the reason why it wasn't bigger was because what if I was wrong and my 100% gain went to 200%? I'm like, all right, so I was just going to buy back that percentage of my portfolio. But the point is that a lot of people can't go to cash. And I said, look, I'm not selling things other than 1/3 of my stock portfolio. I wasn't selling any of my cryptocurrency stuff because I felt like that still had some legs to run. And look at where we are now, right? But my point being is that I said, I'm going to accumulate cash. So the money that goes into my pocket is not going to go into a stock, into a crypto, into gold and silver. It was just going to settle down. Now, I did make the call to buy gold at, $18.50. I said, hey, this is good. I called my broker, and there was a FUBAR, a little miscommunication, and I didn't lock in that trade. Now look at, I lost $100 on that trade. But my point being is this: it's not the end of the world. And so few investors understand, because they're speculators, not investors. They just feel like they've got to be invested in something. Well, so let me tell you, I think cash is really important right now. I'm not saying sell your stuff. This isn't financial advice, because I'm preparing, and this is what I'm going to go on the next channel with. Deflation is coming to certain aspects of the economy right now. As a matter of fact, right behind me, or right behind you guys, behind you, not me, I'm looking at a construction site. And construction companies, I've noticed just recently on Facebook Marketplace, small to medium-sized construction companies are liquidating their heavy equipment right now. And a lot of that equipment's new. It was purchased from 2019 till now. And we are in a moment where there is so much happening that people don't pay attention to, and there are a lot of companies that are hurting. So there's like opportunities. You guys know that I made a lot of money selling tractors and heavy equipment back in during the Great Recession. And so Warren Buffett is sitting on the largest cash hoard in history. As a matter of fact, Apple's on a massive cash hoard. Smart individuals are sitting on a lot of cash because they're about to take advantage of a massive crash coming in 2024. Again, I'm not telling you to sell something that you have bought, but if you bought something, with massive conviction, let's say gold because of inflation, or crypto because of technological advances, you don't have to always go out and buy more. You could always sit back and go, hey, what if it was a dip? I still believe in the fundamentals, but I also believe there's a bunch of idiots out there running around with a sell button and with a hairpin trigger to smash that thing. And I might be able to really get ahead if I sell. So just some food for thought. Again, it's not financial advice. I'm just a dude with a bro hawk and a dream. But I just want to give you a little bit of hope. This is, don't believe the hopium that the president's telling you, or a financial economists are telling you, because they were all wrong in 2005. They were wrong in 2006, all the way to 2009. And actually they were screaming and crying on TV. That's right, in 2008 and 2009. My point being is that you've got to go by your convictions. And so I hope you got something out of this. Take a look at that link down below. That is a bombshell video that's on my other channel, if you wouldn't mind hitting the subscribe button. But it's talking about mortgage-backed securities. They're now imploding. And the reason why I know it is because Fannie and Freddie are now investigating. And trust me, if you look at the links between who the CEO of Freddie Mac was and what job he just left, you'll know there's not only smoke, the houses are on fire. And I can't wait to start picking up these houses for pennies on the dollar. All right, with that being said, the Economic Ninja is out.